Hello and welcome to this video where I'll be summarising an area of the TX syllabus that can be quite challenging at times for students. My name is Aileen Edgar and I am an expert tax tutor. Today I'll be talking you through the topic of corporation tax groups, focusing on where they're similar and how they differ. My aim is to help you feel more confident in being able to spot which group setups apply to a particular question and how to avoid becoming muddled between them. And I'm going to do this by using some summaries and short, simple examples. So in this session, we'll be focusing on two particular group scenarios, 75% group relief groups and 75% chargeable gains groups. Now, there are other groups covered in the TX syllabus, such as VAT groups, but we're going to focus on these two groups here because these are the ones where students can sometimes get muddled between them, as they've got some similarities, but also some crucial differences. Also, these groups tend to be the ones that you have to spot for yourself in a question, so you need to know what to look out for. Now, a good starting point is to consider what are we trying to achieve with these groups, and it's all about saving tax. Group companies have a close relationship with each other, so if one company in the group saves tax, then that's actually a good thing for the others in the group because they've got some sort of shareholding in it and will benefit from more profits being available to be distributed as dividends. With a chargeable gains group, we're only looking at sharing chargeable gains or losses with other companies in the group, so it's very restricted. But with a group relief group, we could be looking at sharing trading losses, QCDs, property losses, but we'll come on to that later in more detail. Let's begin then by considering how to spot a 75% group relief group. Two companies are members of a 75% group relief group where one company is a 75% subsidiary of the other, or both companies are at least 75% subsidiaries of a third company. Indeed, we can have many more companies in a group than this, but it can help just to keep it simple to begin with. A company, known as the parent company, has a 75% subsidiary if it owns, directly or indirectly, at least 75% of its ordinary share capital. And it has the right to 75% of more of its distributable profits, and it has the right to 75% or more of its net assets on a winding up. For sub-subsidiaries to be in a group, the parent company must have an effective interest in the sub-subsidiary of at least 75%. So if X Limited owns 80% of Y Limited and Y Limited in turn has 75% of Z Limited, this means that X Limited and Y Limited are in a group relief group together, as there's at least a 75% relationship between them. But Z Limited won't be in the group with them because X Limited only owns 60% of the shares indirectly in Z Limited. Now, how do we find that? We multiply 80% by 75% and we get 60%. But Z Limited could be in a separate group relief group with Y Limited as they've got at least a 75 relationship between them. Now, are there any other restrictions on who can be a member of a group relief group? We do count foreign companies, but they can't actually take part in the sharing of losses for the purposes of the TX exam. Why would we count them in? Well, it's because that foreign company might have a UK subsidiary that we could then get access to via an indirect holding. We use different terms for different members in the group. The company giving away a loss is called the surrendering company, and the company receiving the loss is called the claimant company. The losses which may be surrendered under group relief are trading losses for the current period, brought forward trading losses to the extent that they can't be used against the surrendering company's own total profits, unrelieved QCDs of the current period, unrelieved property business losses for the current period or brought forward. Now, by excess or unrelieved, what we mean is amounts that cannot be set off against other income in that period. Of this list here, we're mainly going to focus on trading losses in this session because they're the most common to see, but do watch out for these other expenses and losses. Now, you'll notice that capital losses are not mentioned on this list, and that's because there is another way that capital losses can be shared, and we're going to look at chargeable gains groups later on in this session. The maximum group relief that can be claimed is the lower of the surrendering company's loss. If brought forward loss, then only as much as can't be used against own current period profits. and the claimant company's taxable total profits, TTP, for the same period after the deduction of total current period and brought forward losses. And notice that this is the maximum that can be group relieved. You can actually choose to transfer less if you wish, which might be useful if, say, there are a few companies you want to share loss with, or perhaps the company wants to carry some of the loss back against its own profits as well as using group relief. What impact is there once we've decided how much group relief is available? Where a group of companies form a group relief group, the losses of one group company may be surrendered to other companies in the group. The recipient company can then relieve the losses against its own taxable total profit, so the group relief is deducted after QCDs in the corporation tax computation. A couple of complications to watch out for with group relief are where the companies in the group don't have the same year end, or where they've not been in the same group relief group for the whole time period of the loss. In either case, you're going to need to time apportion the profits and losses to arrive at the common time period and therefore the amount that can be shared. Now, we're going to look at an example of working out the amount of group relief available to be relieved. So we've got Puddle Duck Limited here that owns 100% of the ordinary share capital of several UK resident companies. All of them have got a 31st of March year end. Puddle Duck's results for the year ended 31st of March 25 show a trading loss of 100 grand, a property loss of 7,000 and QCDs of 2,000 alongside a chargeable gain of 15,000. And we're also told the company has a brought forward trading loss of £25,000. We're being asked what is the maximum amount of group relief that the company can surrender for the year ended 31st of March 2025. This example is showing you how we work out the maximum group relief available in a situation where we've got some losses or expenses brought forward from a previous period. So we've got a trading loss brought forward of 25,000. Property loss from the current year of 7,000 and QCDs from the current year of 2,000. Now all of these amounts need to first of all be set against income that we have in the current year before being added to the amount we can group relieve. Now the company doesn't actually have to use those losses in that way, but in order to work out the maximum group relief amount we need to net the figures off against current period income. So that means netting those amounts off against the 15,000 of chargeable gain. That then leaves us with 19,000 of a loss that we can add to the £100,000 of current year to get an overall maximum group relief amount of 119,000. That 119,000 could then be given away to one or more subsidiary companies to reduce their taxable total profits. But remember that those companies can't take more loss than they can actually use in that year. Some tips now for you with these 75% group relief groups that we've been looking at. When you're practicing, to begin with, it can be helpful to draw out the group structure on paper and use different coloured pens to draw circles around different groups that you spot. But of course in the exam you won't be able to do this, so I wouldn't rely on this approach once you've moved into your revision phase. But you could use the scratch pad in the exam to list out all the companies and their respective shareholdings. You need to make sure that you put the control running down the page, so put the overall parent company at the very top, and then their subsidiaries below, and then any of their own subsidiaries below that. Make sure to look out for direct and indirect holdings to include as many companies as you can in the group. You want to make the group as large as you can so it gives more options for how to use losses efficiently and to save tax overall as a group. And remember that the percentage holding in a company is only relevant for working out whether companies are in a group relief group. It's not relevant in determining the actual amount of group relief available. So if you have an 80% holding in another company, you're in the same group relief group, but you can absolutely give away 100% of your loss if you wish. And when you're deciding where is best to allocate the losses, once you have established what options you have, you should consider if any of the companies are paying corporation tax at a higher marginal rate than others, or if some companies are paying their tax by instalments. And those are the companies you want to prioritise giving losses to in order to hopefully reduce their tax bills by the biggest proportion, or bring some companies down to a level of profits where they won't be paying by instalments, which would be better for their cash flow. Now we're going to look at 75% chargeable gains groups. Let's begin then by considering how to spot a 75% chargeable gains group. We're looking for one company owning at least 75% of another company, and that subsidiary has at least 75% in another company, and so on. But the parent company must also have indirectly more than 50% of the holding in a sub-subsidiary. Let's look at an example. We've got L Limited, which is the parent company here. It's the one at the top of the structure. It's the one with the holdings in subsidiaries. To see which companies would be in the same chargeable gains group with L Limited, we are looking for two criteria to be met. We need to have at least a 75% relationship at each level of the chain, and we also need to have more than 50% relationship between the company at the top, L Limited, and any company lower down. Now here we can see on the left hand side that between L and M and between M and O, we've got at least 75% relationships that we're looking for. But if we want to include O, we need to check that L has more than 50% holding in O. How do we check that? We multiply 80% by 75%, which comes out at 60%. And this is more than a 50% holding, so we can include O in the same chargeable gains group as L and M. But can we make our chargeable gains group bigger? Can we include N and P? L and N have got at least a 75% relationship, but do you see that P and N don't have a 75% relationship with each other? So regardless of the fact that L has got more than 50% of the shares in P, indirectly via N Limited, because we don't have the 75% relationship between N and P, P Limited cannot be in the chargeable gains group. So in this example then, P Limited is the only company that is not in the chargeable gains group. And what impact is there once we have determined which companies are in a chargeable gains group together? Well, gains or losses that arise from assets can be transferred between companies in the group in order to more efficiently use capital losses. Rollover relief is available where the replacement asset is acquired by another group member. So if Company A disposes of a qualifying asset and within the 4-year window Company B acquires a qualifying asset, then the gain from the disposal by Company A can be rolled over to Company B. And when an asset is transferred between one group company and another, we don't need to work out whether a gain or loss has been made, as the transfer is treated as made at no gain, no loss. They don't need to physically transfer the assets to the other company. The companies can elect for the transfer of ownership just on paper without the assets physically moving. Are there any other restrictions than what we've seen so far on who can be a member of a chargeable gains group? We do count foreign companies, but they can't actually take part in the benefits of being in the group. But different to our group relief rules for chargeable gains group, a company cannot be in more than one chargeable gains group. Some tips now for you with these chargeable gains groups that we've been looking at. They're very similar to what we saw for group relief groups in that you should make sure you're comfortable with which companies have control of which subsidiaries. Check the conditions applied regarding the direct and indirect relationships, remembering that for a chargeable gains group this is slightly different to what we see for group relief groups. You want to make the biggest chargeable gains group you can in order to give the group as a whole more options to save tax, so that's similar to what we did for group relief groups. And the percentage relationship between a parent and its subsidiary is only relevant when we're working out whether a company forms a chargeable gains group with another. It doesn't actually restrict the amount of relief the company can obtain. In summary then, for a group relief group, we're looking at a company and its 75% subsidiaries, both direct and indirectly. Only UK companies can participate in the group. A claimant company can take what it can use in the current period and no more. Group relief is deducted from taxable total profits. Watch out for different accounting end dates and companies joining or leaving the group during the period. Advantages of a group relief group are they can choose any amount of relief up to the maximum. Chargeable gains groups, We're looking at a company, 75% subsidiaries and their 75% subsidiaries and so on, but we need to check that we've got more than a 50% holding indirectly. Only UK companies can take part in the benefits of being in a chargeable gains group. Watch out for rollover relief because it can be claimed on assets disposed of by a group member against another company's purchase of an asset. And advantages of being in a chargeable gains group are we can transfer assets at no gain, no loss, and we can claim to transfer gains or losses amongst the companies in the group to save tax overall. Now, if you need to revise these different group structures and look at some of the further issues, such as the sale of an asset outside of a chargeable gains group, then there's some excellent resources available to you for free in the ACCA Study Hub. If you're looking specifically for further detail on the topics we have discussed in this session, I recommend you have a look at Chapter 20 of the TX Study Hub. This chapter covers corporation tax groups that we have looked at today. Question practice is so incredibly important in preparing for your TX exam, so make sure that you have a look in the quizzes section of the Study Hub for quizzes on groups. And also we have some revision questions in there as well in the practice area. Thank you for watching. I hope this session on corporation tax groups has helped your understanding of this topic and built up your confidence that you're going to be able to spot the groups that are relevant to a question in the exam and apply them accurately.